In 2025, the world is watching emerging markets under pressure. But amid that turbulence, one question continues to haunt dinar holders and currency speculators. Will revaluation of the Iraqi dinar finally happen this year? It's not a question of clickbait, it's a question with real stakes. Across Iraq's economic reports, IMF pronouncements, rumors about US banks, and whispers of political maneuvering, signals are mixed. Today, we'll unravel what's hype, what's plausible, and where 2025 might actually take us. Let me warn you, this is not a fairy tale of instant profits. It's a complex dance of macroeconomics, political will, external shocks, and timing. So lean in, because by the end of this video, you'll have a clear, evidence-based view on whether a revaluation is realistically on the table in Q4 2025 and what to watch next. Before we dive into Iraq's particulars, we must situate the dinar in the broader context of 2025's global macroeconomics. By 2025, many central banks remain hawkish. The US Federal Reserve and European central banks have maintained relatively elevated interest rates even as growth slows and inflation retreats. The higher-for-longer narrative has weighed heavily on emerging markets, especially those with external vulnerabilities and commodity dependence. Commodity cycles matter for Iraq. Oil remains the backbone of Iraq's external revenue. Any global demand pressure or supply volatility ripples directly through Baghdad's budget, foreign reserves, and fiscal room. Weak oil prices or demand could tighten constraints. Conversely, a rebound helps relieve fiscal stress. In risk-off markets, capital tends to flee towards safe havens. Emerging markets with weaker fundamentals see greater volatility, higher spreads, and capital outflows. In such environments, currency revaluation is less likely because the costs of credibility gaps become more expensive. On the flip side, if global sentiment shifts towards searching for yield in emerging markets, then countries with credible reforms can attract inflows. But that's a high bar, and 2025 is not offering many such tailwinds without strong signals. Iraq sits in a volatile neighborhood. Its stability is affected by regional conflict dynamics, shifting gas and oil geopolitics, and relations with Iran, Turkey, Gulf neighbors, and superpowers. A global shock, such as energy market disruptions or sanctions, could derail even the best-laid domestic reforms. Thus, any revaluation hypothesis must clear the hurdle of exogenous risk. That's a major reason why even proponents of revaluation view it as conditional, not guaranteed. Now we turn to perhaps the most authoritative voices in global finance. If a revaluation is going to gain legitimacy, it will pass through the lens and pressure of institutions like the IMF and World Bank. In July 2025, the IMF Executive Board concluded the 2025 Article 4 consultation with Iraq, and their press release and staff report offer key insights. One headline: in their baseline, they project the average exchange rate for dinar per US dollar to remain approximately 1,300 for both 2025 and 2026, the same level as prior years. In other words, the IMF is not currently baking a sharp, imminent revaluation into its base forecasts. The exchange rate assumption is stable. Their report also flags serious risks. Iraq's fiscal expansion in 2024 put strain on financing, leading to arrears accumulation in energy and capital spending. The external position is weakening, with oil export revenues under pressure and narrowing current account. Non-oil growth is projected to weaken, just about 1% in 2025, amid constrained government spending. In short, the IMF sees very modest inflation, around 2.5%, and a broadly stable exchange rate path unless adverse shocks intervene. Thus, from the IMF's vantage, revaluation is not excluded, but certainly not in the baseline. An important telling shift. Beginning January 2025, Iraq rerouted all international transactions via commercial banks through their corresponding banking relationships. That means the central bank is stepping back from restrictive direct controls and letting the standard banking plumbing operate.
Also, the IMF notes that Iraq no longer enforces current account restrictions or managed currency peg constraints under Article 14, Section 2 of IMF rules. These changes improve credibility and marketization of foreign exchange flows. They reduce one friction that often blocks revaluation-ready behavior, but they fall short of a commitment to revalue. While direct World Bank commentary on revaluation is limited, its broader assessments of Iraq emphasize weak diversification, dependence on oil, and institutional weaknesses. On a more constructive note, in 2025, the World Bank approved a $930 million railway modernization project in Iraq. That signals willingness to invest in infrastructure that supports trade and connectivity, which over time can support macro stability and economic diversification. The World Bank's broader MENA outlook also underscores the fragility of the region's growth prospects and the importance of structural reforms. In sum, the World Bank is backing long-term institutional and infrastructure improvements, but has not indicated direct pressure toward an imminent currency reset. One of the most persistent topics in dinar forums is whether major U.S. banks like Chase, Citi, or Wells Fargo will participate in revaluation exchange schemes or be co-opted into tiered exchanges. Let's examine how realistic those rumors are. In online communities, you'll find three overlapping claims. Tier 4 banks will get IQD flows or buybacks before retail. Citi or JP Morgan will act as intermediaries to convert dinar for U.S. holders. The Federal Reserve or national settlement systems have approved IQD corridors. These narratives thrive because they suggest that normal banks will magically bridge the gap between exotic currency and global liquidity. But there's a practical wall. Global banking systems operate on strict regulatory, settlement, compliance, and liquidity frameworks. Correspondent banking relationships require banks to vet counterparty risk and currency settlement systems. It's not trivial to add IQD overnight. U.S. banks face regulatory and internal risk committees. For them, dealing with an exotic currency without clear legal and liquidity frameworks is a red light. Even if corridors open, banks need sufficient volume, hedging options, foreign reserves, and derivative tools to manage exposure. Many rumors rely on underground memos or insider access, but lack verifiable public confirmations from banks themselves. In short, the burden of proof is on the rumor side. Until JP Morgan, Citi, or Wells Fargo publish credible statements, we must treat these as speculative. That said, small signals matter. If you see any bank suddenly opening an IQD wire channel or listing an IQD exchange product in regulatory filings, or an SEC filing hinting at foreign exchange corridors, those are valuable to track. But to date, no verified U.S. bank has confirmed full-scale participation in IQD revaluation programs. Thus, any scenario that leans heavily on U.S. banking involvement must remain speculative, not foundational. To assess the plausibility of revaluation, we must examine how other countries or Iraq itself managed past adjustments. Patterns and pitfalls offer guidance. In December 2020, Iraq significantly devalued the dinar from around $14.50 per US dollar to $14.60 and higher in the parallel markets as oil revenue collapsed and fiscal strain rose. In February 2023, Iraq purportedly revalued by adjusting the peg from $14.50 to $1300. This was often characterized as a reversal of the earlier devaluation, but in practical terms, it was modest. Those moves were cautious, limited, and often more symbolic than wholesale. They reduced the official gap between parallel and official rates, but they didn't unlock massive revaluation gains overnight. Experience in emerging markets shows that revaluations often require strong macro fundamentals, stable inflation, credible fiscal balance, and a foreign reserve buffer. Gradual adjustments rather than sudden jumps help avoid shock inflation. Communication and transparency matter, so markets internalize expectations. Institutional support from central banks and international institutions is key. Avoiding distortionary wholesale jumps helps minimize the risk of backlash. Clickbait predictions often skip these prerequisites. We can thus distill a key lesson. Revaluation is typically not a singular event, but a path of credibility-building steps followed by a calibration move. Countries with weak institutions that attempted sharp revaluations without reserves or credibility, such as some in Latin America, often saw backlashes, capital flight, inflation, or reversal. Conversely, those like China, which managed revaluation, or selective currency pegs, used gradual crawling pegs or two-phase adjustments over years. The more credible the institutional framework, the easier a modest revaluation becomes. So for Iraq, the question is whether 2025 can deliver enough credibility to justify a modest upward adjustment, not a moonshot. Even with macro and institutional pieces in place, political and structural factors in Iraq will be decisive. Leadership, governance, and reform appetite matter. Prime Minister Mohammed Shia al-Sudani's government has pushed reform.
The creation of the Iraq Development Fund in 2023 has allowed pro-investment projects, and as of 2025, it claims to have attracted around $7 billion in foreign direct investment. Politically, Al-Sudani's Reconstruction and Development Coalition, founded in May 2025, aims to shape the November elections and promote a reform agenda focused on infrastructure, private sector growth, and transparency. Still, Iraq's politics remain fragmented, vulnerable to regional push-pull, and subject to internal factionalism. Any major move like revaluation will provoke winners and losers, and political resistance must be managed. Oil is still more than 90% of export revenue. When oil prices are favorable, Baghdad has leeway. When they fall, fiscal stress intensifies. In 2025, the IMF suggests the fiscal cushion is narrower and arrears are rising. Crucially, IMF staff report that the budget break-even oil price has moved upward under strain, meaning Iraq needs higher oil prices just to balance. Thus, unless oil recovers sharply, Baghdad has less political capital to risk a revaluation-induced shock. Projects like the World Bank-backed railway enlargement are promising, yet Iraq still suffers from weak non-oil growth. The IMF suggests that non-oil GDP may grow only around 1% in 2025 amid constraints. If more foreign investors commit long-term capital into infrastructure, manufacturing, or energy projects with revenue in foreign currencies, that can support currency confidence. But those investments take time to materialize. Let's map out the potential benefits and risks of a revaluation in 2025. If properly calibrated, revaluation can temper import-driven inflation, improve consumer real incomes, and stabilize prices for essential goods. A credible revaluation sends a strong message to markets and institutions that Iraq is committed to normalization, potentially attracting foreign investment. One long-standing drag on confidence is the divergence between official rate and black market rates. A calculated revaluation can help narrow that gap. If combined with stronger reserves and foreign exchange operations, revaluation can support reserve accumulation and remove speculative pressures. For holders waiting decades, revaluation is a narrative, translating hope to what feels like legitimacy. That shift can drive further confidence. But a sudden appreciation can trigger volatility, especially in a country that relies heavily on imports. Domestic producers may suffer, and inflation dynamics could respond unexpectedly. Exports or local industry could become less competitive if the currency rises too much, hurting non-oil GDP, an already weak segment in Iraq. If banks, foreign exchange desks, or market makers lack depth, a revaluation can worsen liquidity crunches or create arbitrage opportunities that destabilize the system. Those on fixed incomes or government wages may resist. Political opponents might exploit any missteps for destabilizing narratives. If revaluation is modest and not earth-shattering, segments of the investor community may feel misled, leading to distrust. In other words, revaluation must be cautious, credible, and incremental to survive the risks. Given decades of speculation about dinar revaluation, it's essential to filter rumors from credible indicators. It's happening next week. Such promises historically never materialize. Banks will call you,
yet no verified bank has confirmed public participation. Tier credentials or priority list insiders, these are used to extract money from hopefuls. New zero removal law leaked, but no government gazette or central bank announcement exists. Iraq Business News recently published a piece called The Iraqi Dinar Revaluation Deception: 10 Persistent False Claims, documenting that many predictions over 20 years failed to pan out. What counts as credible? Central Bank of Iraq formal gazette statements or press releases about revaluation or redenomination. New foreign exchange corridor announcements, licensing, or structural banking memoranda. IMF or World Bank conditional program statements tied to exchange policies. Public budget documents or reserve statements that show capacity to support a move. If a claim exists only on Telegram, Instagram, or unverified forums, treat it as rumor. Let's now dig into what market watchers and analysts are forecasting heading into Q4 2025 and what those views imply. Some markets expect marginal movements around the 1300 mark. For instance, certain commentators project the rate might move to 1318 IQD per US dollar by end of year, signaling a small depreciation rather than appreciation. That kind of slight drift is consistent with modest weakening under pressure rather than aggressive revaluation. More bullish voices, especially in dinar enthusiast circles, suggest that with enough reform momentum, the rate could edge toward 1200 or even 1100. But this scenario requires nearly perfect execution, credible external backing, consistent reform, inflation contained, and no shocks. Given everything, the most plausible base case path is the official rate remains around 1280 to 1320 with small drift. No dramatic leap or zero removal in 2025, some modest narrowing of parallel gap. Any revaluation appetite will be deferred into 2026 or later, once more institutional groundwork is in place. If oil markets improve or reforms surprise positively, a mild appreciation might occur. But a full-blown revaluation return will require more runway. A more credible revaluation window may open when reserves build up sufficiently, non-oil growth is sustained, institutional reforms embed trust, and global risk appetite returns. In that window, a 10 to 20% revaluation, or a shift from 1300 to mid-low 1100s, is more plausible than an overnight leap to $1 equals 1 dinar fantasies. Given all the uncertainty, what should you, as an investor or observer, do in 2025? Follow Central Bank of Iraq announcements and gazettes. Set alerts for new laws, exchange rate announcements, redenomination statutes, or foreign exchange corridor licensing. Track daily bulletins and auction data. The central bank posts lists of maximum US dollar selling prices and volume. A sudden jump or widened range could hint at change. Watch IMF conditional programs or statements. If a future IMF deal ties exchange rate policy to funding, that's a structural force. Monitor parallel market spreads. If the gap between official and parallel rate narrows steadily, that tends to prelude adjustment. Be skeptical of priority list offers. Don't pay money for privileged access. Verify claims by checking official sources first. Diversify exposure. If you hold IQD, consider maintaining part of your capital in stable or liquid assets to hedge risk. Use incremental entries. If entering new exposure, do so in stages rather than lump sum, awaiting confirmation signals. We arrive at the final, cautious but hopeful verdict. A dramatic revaluation from 1300 to 100 in 2025 is extremely unlikely given macro, institutional, and risk constraints. The IMF stance shows no built-in revaluation expectation. Their projection remains stable at approximately 1300. But 2025 is not devoid of possibility. Structural reforms, central bank corridor moves, transaction routing, infrastructure investments are being instituted. These pave the path for future legitimacy. Political will, oil revenue strength, and external shocks remain wildcards. If Iraq executes policy flawlessly and global sentiment permits, a modest upward adjustment or at least narrower spreads is possible by late 2025. Under realistic assumptions, 2025 is a setup year, not a breakout year. Expect at best a modest move, a few percentage points of appreciation or narrowing of gaps. The dramatic revaluation dreams will likely have to wait for 2026 or beyond, when greater institutional credibility, stronger reserves, and sustained economic growth converge. If you're an IQD holder, that means patience and vigilance outperform aggressive short-term bets. Watch for confirmatory signals, don't chase rumors, and always keep some capital in fluid holdings in case the moment arrives. Thank you for tuning in to Dinar TV In-Depth Analysis. If you'd like a chapter-by-chapter downloadable version, a trackable indicator sheet, or Q&A follow-up for holders, let me know in the comments. Happy to build that out for you next.